Good afternoon, traders. Good afternoon, at least if you're on the East Coast or Central Time Zone in the United States. Hope everybody's having a great Monday. Certainly been a eventful, really morning, weekend, a couple of weeks here in markets. So lots of fun, lots of trading action, little uptick in volatility across several markets. Hope you're having fun with that. Appreciate each of you. Grateful for you spending some time with us today. My name is Jason Paff. We're going to look at 5 indicators every trader should know. So taking a little bit more of a technical angle on markets, how to look for pivot points, how to, if you're in a Nadex market, planning a trade, looking at entry points, exit points, how much a particular contract might move based on recent history. We'll look at some indicators that can help you with that. Certainly like to give the disclaimer off the top, no indicator is perfect. There's nothing that works all of the time. And there'll be time periods where an indicator will work really well for a certain amount of time, and then you'll lose your touch with it. And that's why I like to give folks, especially newer traders or intermediate traders, a nice walk through several different kinds of indicators. Over time, your style should evolve, your ability to use different indicators on different time horizons will evolve. For me, it's really about digging in, diving in, using your Nadex demo account perhaps to test out some trades and test out some indicators and see what works for you. Build some expertise, build some history with different indicators, and then see what works best for you, your trading style, and your level of risk. As I said, my name's Jason Paff. I come from thedutchbook.com, where we provide what we consider to be sophisticated analytical quantitative research for traders. We love Nadex, so we certainly have a bias towards short-term traders. Individual traders are our passion. So we look at things over certainly an hour, a day, a week. And typically, most of our forecasts run over the course of a week to align with our Nadex subscribers. So typically what I do, and this is actually good context, I'll look at a lot of different viewpoints. So we call ourselves quantitative in nature, but that's not to say we only look at quantitative things. We'll look at fundamental factors, we'll look at quantitative or data, and then we'll also look at technical indicators, which is going to be the focus for the rest of our time here. I say that just to encourage, you'll hear me say this a couple of times as a reminder through our time together. Use lots of different indicators, get data from different points. Now, there's always a risk in too much data. There's always a risk in too many indicators, so you certainly want to stay away from that, but there's a healthy balance, right? I always get concerned when a trader has one tried and true thing that they always use and that always works. If we're doing fundamental research, we want to read just as much or more from a counter point of view, just to make sure we've checked all of our different possible scenarios. If I'm using a technical indicator, I might want to confirm it with other technical indicators across different time horizons. So I grew up forecasting oil and forex. That's really my love, my passion. I'm sure some of you have your favorite markets. Grew up in Oklahoma. But most of all, what I want to share with you is I just love being here with each of you today. I always take more away from your questions and feedback than I could ever possibly hope to give. So certainly encourage questions as we go, interaction, and certainly let me know what you think as we go along. First things first, certainly our risk disclaimer. Just want to make sure everyone is aware of a few things off the top. Certainly trading on Nadex, our partner here today, involves financial risk. Certainly might not be appropriate for everyone. You want to make sure in any trading plan and any strategy and any trade you're looking at that it fits with your risk tolerance, your financial position, your trading goals. Anything we look at with respect to past history or past performance is not in any way, shape, or form indicative of future results. And certainly want to remind everyone that trading can be volatile. You risk losing your entire investment on any single transaction. We'll look at some volatility measures here in a bit on the broadcast. All right, so to begin, just wanted to set the stage on technical analysis, which is, again, really our focus here today. A couple of assumptions form the basis for technical analysis, right? There's a few things that you have to believe or agree with, or at least understand could possibly be true. One is that markets, maybe a particular market or all markets, move in certain patterns, right? A technical system or a technical indicator largely is built on data, price levels, et cetera, from the past. And typically those indicators are looking for patterns, or they're built based on a pattern and how things have worked in the past. If you're using an indicator to look for where a reversal might happen, right? You need to believe, or at least have some type of assumption that that indicator's been built on the way that that has worked in the past, and that that pattern will continue at some level into the future. They'll repeat, right? Indicators, as I said, can be used to detect patterns, and in some cases will give you an indication of what might happen next. In some cases, we'll look at moving averages here in a second. They might just tell you in real time what's happening, or they might tell you what's already happened. But for that to be the case in terms of a technical indicator telling you what could be on deck, the patterns that might be present in the markets would need to continue to repeat. So with respect to technical indicators, and talking about your mindset as a trader, your mindset as an individual trader, I just like to encourage everybody, certainly anytime you're taking on any new subject matter with respect to trading, really a balanced mindset. There's going to be wins, there's going to be losses, there's going to be times that it works, and you can't wait to tell somebody about it. There's going to be times where you may have a couple of trades that don't go your way using the same indicator at the same time of day in the same form or fashion. Stay positive. Know that losses lead to learning. Learning creates speed in terms of getting to where you want to be in your goals. And that balanced mindset with respect to it, technical indicators is really helpful. The first couple you try to use may not work for you. They may not fit with your style. You may not understand them like you thought you did. That should not deter you necessarily from other indicators or from continuing to experiment, maybe in your Nadex demo account, with different types of indicators. That sense of experimentation, if you're earlier in your career as a trader, is really important. And I think everyone knows that here on the call. I think each of you know that conceptually. But I just like in venues like this to give you social permission, right? So often, if you're in a losing streak, or you're newer, or maybe it's been a while since you've traded and you're coming back, you need to be told it's okay to experiment and to know that there's going to be some trades that don't go your way. And so don't get frustrated at first. Our purpose here today is really to clip through rather quickly a few. We're going to go through 5, should spend in total, 30-ish type amount of minutes going through these 5. And then feel free, again, to go to nadex.com/demo, download an account, practice on your own, look at different indicators with some practice trades. Learn more about the indicators, certainly get some different types of research about the things we talked to today, so you can get a different viewpoint than my own. Then later in the month, we're going to have a part 2. Be on the lookout on the webinar schedule. We'll get this up on the schedule very soon, but this is intended as a 2-part course, so 2-part webinar. So we're going to just kind of get a lay of the land, look at 5 indicators that measure different things. As maybe a binary options trader on Nadex, you might want to be familiar with. And then part 2, we're going to come back later in the month, and we're going to look at just live examples, and we're going to go through in real time some trading opportunities, some things that indicators are showing me in real time. You can participate in the chat box with that. Tell me maybe what you see. Maybe you agree, maybe you disagree. We'll look at it together and really put some of the things that we touch on today, and that maybe you spend some time over the next week or 2 with on your own. We'll put those into action on a webinar here with Nadex, so that we can all have some practice with it. So it's a really cool concept. Hope that works for you. Hope you're excited about it. But we designed this so there's a week or 2 in between, so that you can have some time on your own, then come back live with questions, comments, feedback, etc. With that, one thing I like to mention up front as well is that there are at times some subjective ways to look at each of these indicators. Some of you may be very experienced in here for a refresher, or maybe you're just interested in a different spin on some of the same indicators. And we'll talk about some of the variables that you can introduce into your indicator as we go. But some of this does get subjective. We'll look at, for example, relative strength index, RSI, later. You know, most of the time, I think most folks consider an overbought or an oversold. And again, we'll look at this if you're not familiar with what I'm referring to here in a second. But some folks may think of that as a level of 70, right? Overbought is above 70. Other folks may like 75, other folks may like 80. You know, so there's some different breakpoints that folks have with each indicator. Some folks might like a 50-day moving average. Some folks might look at it hourly, right? And certainly as a short-term trader, you might not want to look at a 50-day moving average. You go on, you know, a different financial news outlet, and all they're talking about is 50-day moving averages. And we'll talk about some of those differences, but I just like to mention that up front as well, that you know, if you're as a technical analyst, you've got some ability to shape the indicators that you're working with, fit them in your trading plan, within your trading goals, what's worked well for you, what feels right, what is something that you have conviction and confidence in. So real quick, we'll start out with looking at moving averages. We'll talk about average true range, moving average convergence, divergence, MACD, relative strength indicator, and stochastics. So moving averages. So a moving average is really a trend following or lagging indicator. Moving average is fairly simple in nature. It will take in past price levels, although you can also use moving averages with things like volume, if you want to measure the volume of a stock and see how that's moving up or down. So a moving average is always going to be lagging. It's not necessarily something known to give trading signals, right? Now, there are instances where it can and where some folks feel like it does, and we'll talk about that, but it's just important to note that it really is a trend following type indicator. There's two types of moving averages to be familiar with as a trader, primarily, at least initially. There's a simple moving average, which for that period of time takes all the values into consideration and just divides by the period that you are measuring. So if you want to do a 50-day simple moving average, you will simply take a daily close for 50 days, add that up, divide it by 50. I trust and I hope you're on a platform, trading software, etc., using some type of charting that does that for you. I'm just explaining how it's built, but a simple moving average treats every value in the period the same. You know, if you're doing an hourly chart and you want to look at a 10-hour moving average on a really tight time horizon, it's going to treat each of those hours the same. An EMA, or an exponential moving average, is going to show a bias, a lean, or a tilt towards most recent prices. So it's still a moving average. You're still looking at the entire period, but the exponential piece means that mathematically on the back end in your charting software, it's showing more of a bias towards the prices or the volume or whatever value you're measuring. It shows a deference more so to the ones that are most recent. So in terms of moving averages, and again, this is just my preference, I really like to use moving averages to give me context. If I'm working between 20, 30 markets, or 20, maybe I'm in forex, but I've got 10 to 15 different pairs, maybe to start the day or the week, or I'll keep it running throughout the week, but I'll glance at each of those and I'll have maybe a 50-day and a 200-day. Or if I'm trading Bitcoin, right, I'll because it's more volatile, I'll move the moving average up and I'll look at a 15 and a 50, just to give me context on where Bitcoin is in relation to the last 15 days, an average, and the last 50 days in an average. And so it gives me context. There are folks that look at a moving average as a potential signal. One that I actually do use in charting, at least, because it's a pretty strong point of context, if not indicator, is what you call a death cross. If you've heard that term, that's when, if you're looking at historically, a death cross is traditionally it's a 50-day and a 200-day moving average. When your 50-day crosses under with conviction your 200-day, that's known as a death cross. Your security, your tradable instrument is heading down. The short-term average is crossed under the long-term average, meaning with pace and velocity, that security or that tradable instrument is heading down. Typically, a death cross is, again, traditionally known as a bearish indicator. But again, remember, it's lagging, right? So it's only going to tell you after it's happened. And so it's just following the trend like we spoke to earlier. So as we said, some common measurements: 9, 26, 50, and 200-day moving averages. Again, for crypto, we might use a 15 and 50. You know, if you're trading very tight time horizons on a binary or a spread, you may move that down. This is one of those areas where some experimentation on your own, just learning, you know, how to look at and how to work with the moving average will really lead you. There's no tried and true perfect way. I like to follow 15 and 50 in crypto and 50 and 200 in equities and major forex for a primary reason that the rest of the market looks at that. And so it's healthy and helpful for me to know when folks are looking at those values and what those values are. You know, if the Aussie moves into a death cross, people are going to be talking about it. Traders are going to know it, and it's helpful for me to know that too. Talked about the calculations there in the signals. Again, for me, it's more of a context piece than the signal, but those crossovers are a very simple, straightforward, but traditional way to look for a trend. Similarly to a death cross, when a 50 comes up and crosses over the 200, clearly that shows you that you have an uptrend or some type of velocity moving back up. So as we can see real quick here on our chart, just an example of two different lines. You can see how they differ. One is a simple moving average, the other is the exponential. You can see the exponential is a little tighter at points to the actual. This is trading the loonie, US dollar, Canadian dollar on a 4-hour. So just give you a little flavor that they will show up differently, right? And you'll just want to understand. And again, it's entirely acceptable to look at both and use both. And you know, some securities perform differently with each one. All right, that is moving averages. Average true range. This is an important one for binary traders, spread traders. It's a very important measurement for us when we're looking at Nadex contracts. This doesn't really indicate direction or trending. Average true range, you'll see it referred to as ATR, is an important measure of volatility, or the range, the price range with which a tradable instrument, an asset, a security has exhibited. So this will tell you as a binary or spread trader, you know, how much an underlying market or how much an underlying asset can move in a certain time horizon, depending on how you set the parameters. So as I said, it's really a measure of volatility. It's a really simple calculation for the most part that, again, we're not going to get too much into any of these calculations. Happy to talk to you offline, or find me on Twitter or send me an email, jason@thedutchbook.com. Happy to follow up with you. It's jason@thedutchbook.com. We could talk about the calculations. I'd love to, a bit of a math nerd myself, but for the most part, your charting software, again, will do the actual math for you. What's important to understand is that basically ATR is pretty straightforward. It'll look at the current high, the current low, and then take the absolute value of the current high less the previous close, the absolute value of the current low less the previous close, and then it'll take a moving average of those prices. So All right, sorry about that. Lost sound for a second. Had some technical difficulties. We will back up here. Sorry about that, some maintenance on the fly. So with respect to ATR, again, very straightforward. You take the highs, you take the lows, and you take an average. A wide and increasing ATR indicates high volatility. If you're a binary trader, it's important to know you have a very defined time horizon. If you're trading a weekly spread or a weekly binary, you not just don't want to know how much this could move over the next year or the next month. You want to know by Friday or by Thursday or whatever your time horizon, how much can this move? This will demonstrate for you, this will give you a value of the average range for the time period that you have selected. Not necessarily a guarantee, obviously, that that's the range for this week, but certainly helpful to give you that context. We also like to look for, again, and we spoke a little bit about this on the slide, wide and increasing ATR. So you can run ATR over different time horizons, and if you run it a little tighter and it's increasing, you might think that your spread has a greater shot to clear a certain strike, given you're in a higher volatility environment. So ATR, real simple. It's concerned with the distance between 2 points as opposed to the actual direction. You'll need another indicator if you want to use it for direction, or maybe you have a certain bias or conviction that you're bringing and you just want to understand how much it can move. Just price ranges is what you're going to determine. ATR can also be used, and this is a good point, to validate the strength or enthusiasm behind a certain move. And then, as we said, it's really helpful for spreads and binaries traders to understand the potential based on the recent history. How much can a certain underlying market move in a certain amount of time? Something else to notice just in general here on volatility, and this is pound yen, the guppy. High volatility, and it depends on the market a little bit, but generally speaking, you see it here in forex. You certainly see it in this. Can also can indicate traditionally that there's a move down in price, right? So anytime you're talking about volatility, that's essentially the market is disagreeing, right, on price for the most part. You could be producing higher volatility just because you're making a sharp move up. You see that sometimes in crypto, maybe, but for the most part, the security, let's say it's the guppy here. All this is typically a pretty highly volatile pair. So maybe you're trading, U.S. dollar, Canadian dollar, and things are pretty even. Market's in agreement, right? Buyers and sellers are meeting at a point, and many buyers and sellers are meeting at the same level over the course of days or weeks or hours, et cetera. In a highly volatile environment, typically the market's in disagreement, and you have wild swings as yesterday's buyers disagree with what today's buyers were bidding, et cetera. Typically that could be an indicator of a potential down move in the markets, and you certainly see this in this chart. The ATR spikes in similar fashions to when the market's moving down. Again, for me, that's helpful contextually. I would not use ATR as an indicator and trading on that, but it would help me give me context that the market's in disagreement. This is a market that's going to move. It's highly volatile, so it's moving, and I may want to do some more research, employ some additional indicators to understand what the potential direction could be. All right. So MACD, the moving average convergence divergence. These concepts will start to build on each other a little bit. So this is a trend following momentum indicator. Again, it's essentially built off of moving averages. So we take the moving averages that we talked about earlier, we're going to roll them into a few additional components here and create a MACD. So this is really a momentum indicator to show you the velocity and strength of trends and where pivot points might be based on the trends, right? And so what the MACD does at a very simple level, and we'll get into what each line is. It's a couple of lines that measure moving averages over different periods of time. And then as those lines move, and we'll talk a little bit here about the ingredients, etc. You know, it'll give you a picture of where that trend is in time in relation to where that security's been. And it means different things as you get divergence or convergence in MACD. That can be an indicator for you on how to trade. So at its basic level, this is about as detailed as we'll get. Again, if you want more details, just reach out, jason@thedutchbook.com. Find me on Twitter, JMPFAFF, or at JMPFAFF. But it's two different moving averages, and then it calculates the distance between them. So the difference, or the two averages, are effectively the 26 period and the 12 period. Again, if you're looking at a daily, that's 26 days, 12 days, hourly, 26 and 12 hours, obviously. So to determine the other line, the MACD line, you simply subtract the 12 from the 26. So the signal line is typically, and again, I've said this up front, just want to continue to be clear, different people might use this in different ways, but historically, traditionally, the signal line is simply the 12 period MA. When there's a crossover, and we'll look at this here in a second, it's essentially what you're looking for. When there's a crossover, it can indicate a new direction. If the distance widens, it indicates a strengthening trend. All right, so when the security price, there's a lot going on here, right? So don't worry, we'll talk about all of it. So when the security price diverges from the MACD, it signals the end of the current trend. The moving averages are separating, right? And so that tells you that something new could be happening. You know, if you have something especially that you want to look for, a classic example of where MACD is helpful. If a security price, for instance, you know, diverges, right? So you have a stock or an indices that you're tracking, or a forex pair. If it's rising and a MACD indicator then turns and starts falling, that could mean that your rally is about to end, right? And so you can see, like, right in the middle of the chart, and these are going to happen very close together because, again, the MACD lines are moving averages. At some point, you know, it's going to move very closely with, in this case, we're looking at oil. But if you look just where that February line is, where February starts, right? If you look just to the left of that line, you can see the MACD line starting to turn. You can see in the histogram, you get some widening over time as that goes, and you can see in the price as well, you've got a downturn in the price of crude. So really what you're looking for in a situation like that is where, you know, you have a trend that's moving up, the MACD lines start to turn, you get some divergence, your histogram starts to widen, and you see the commodity forex pair or equity that you're trading start to follow it. So as, again, the signal line is the 9-day exponential moving average of the MACD line. This will trail the MACD and make it easier to spot MACD turns. That's the yellow line there on the chart. Again, the histogram just measures the distance between the two. You know, typically you're seeing some action in a trend. That's an oscillator, so that moves up above zero, and your histogram gets larger. You know, that's a uptrend. Downtrend works the opposite way. Again, in that February move there in crude, you can see it headed down. So just helping you to confirm the trend, measure the distance between the two, and strengthen your ability to spot those situations. So in terms of crossovers, again, that's really what's important here with MACD. If your MACD line falls below the signal line, again, just looking back at that move in February, right there on that white line in the middle, you can see the MACD fall right below the signal line, and the commodity follows it. Same thing with that move there at the end, right before the June line. And you know, it looks easy on a chart like this, and it is much easier than real life trading. We all know that, but there's always those times. There's few times harder as a trader when you're enjoying a run, right? You called it. You know, let's say in this case, you know, in January 1st, 2018, you're into crude and you're riding it up. And again, that's maybe a different market. Let's say, again, in the case of, you know, Nadex, even it's a weekly contract, right? And the beginning of the week, out of the gate, you're on it. And there's always a decision as you go. You know, how much more should I let it go? When is it going to turn? What is my signal? What is my indicator? If you're having trouble with some of those decisions, MACD could be a reasonable solution for you. Again, get some practice with it, experiment with it on your nadex.com demo account. But as you can see, as that trend starts to wobble, if you can imagine yourself in real time, half of your brain tells you, well, you know, it's going to continue going up. This is just, you know, you get one red bar. Well, we're still in an uptrend. Maybe we could go up. You get two red bars. If you're watching your MACD, that might be confirmation of the signal. You may think that's a good pivot point, a good time to exit, and you know, you could make your trade and keep it moving. All right, I'm gonna check the box real quick, see if there's any questions. If you do have questions as we go, feel free to drop them in. Just checking these here. Not seeing any this second. All right, if you have questions, please drop those in. Sorry about the sound there. A few comments on the sound, I appreciate that. So with respect to, again, if you do have questions, drop those in the box. This really was designed, as I said up front, maybe you just joined us, as a two-part piece where we're going to look at some real life examples in a week or two. So we wanted to give you some concepts here. So if a question comes up after the webinar, don't worry, write it down, bring it back, maybe research it on your own, get an answer, and then come back and you know, we could talk about it in part two. So RSI, Relative Strength Index, this is one I use a lot, just as confirmation of what I might already be seeing on a chart. So RSI is a momentum indicator. It's going to look at the magnitude of a move. It's going to look at gains and losses over a certain period of time, just to measure the speed or the velocity and the change of price in movements. Again, a traditionalist would say 70 and 30 are your critical levels. Some folks look at 80 and 20. I look at both. Again, there's no one right way to do it, but typically, if you have on an RSI reading a level of 70 or above, that's overbought, meaning your trend may be nearing an apex. The momentum, the speed is slowing down. You've been on a good run. People have been bidding up, buying up the security, but that is slowing down. Your rate of change in the price moving up is slowing down. As I tell folks all the time, typically 90% of the time it slows down before it stops, right? And so you've been rising fast and fast and fast. RSI is going to measure that change in the speed. Maybe it's rising a little slower, it's smoothing out, and that may be positioning for a move back down as the security or the underlying market may be ready to retrace some of those recent gains. So the calculation, so again, it's just the average gain of up periods during the specified time frame versus divided by the average loss. And so as those averages, let's say in the case where it's moving up above 70, the case where those averages are getting smaller, your RSI will indicate that for you, which means the up moves are narrowing and it could be at or near a peak. All right. So here we have your RSI charted kind of against the backdrop with some candles. We talked about overbought, oversold levels. Again, 70 and 30 is a pretty good level. You can see, and really, again, I mentioned using both 70 and 30. It's really when it approaches those levels that it's ready to turn. So you can see that first big move there around the 14th. We're almost to 70, indicating overbought, and the candles begin to turn as we're heading back down to under 30. You know, that might be an instance where you say, hey, this trend is running out of steam downward, and it might be time to make a bid as it's an oversold territory. Doesn't always work out that way, but it's a good indicator for us. Again, when you see something that's just been trending and trending and trending in one direction, we want to know the rate of change in that trend, and your RSI will give you that. So you can see there on the far left, the RSI is very low, and as it starts to work its way back up to that first peak, the RSI works up as well, but that up move really started when the RSI was down below 30, indicating that downtrend that the candles come in on the left side has ebbed, it's run out of steam, and the market bids it back up. All right, the last indicator we're going to look at today, and again, invite each of you back. We're going to get the part 2 up on the calendar. So we'll look at some live examples. You'll be able to pull those up. You'll send me questions, comments, and feedback in real time. We'll look at how to deploy these. Just wanted to introduce the basic concepts. You can go to a nadex.com demo account, practice, experiment, and then come back with some questions, and we look at some live potential trading. So stochastic is an oscillator. It's a momentum indicator. It'll compare the closing price of a security to its prices over a certain range of time. So there's an assumption that goes with stochastics, and this can be fairly misunderstood. Stochastics have been around for a long time, and there's some people I respect that look at them a lot. Somebody like Gail Mercer, who you guys may be familiar with, does a great work as a Nadex educator. Check her out on Nadex Market News. She publishes articles there. She'll look at stochastics. Stochastics has been around since the 50s. We'll look at stochastics from time to time as well, but there's an assumption that I always like to ensure that folks are aware of, and that is, in an uptrend, the assumption of stochastics is that prices will close near the high on a daily basis. Let's say you're measuring daily. And in a downtrend, on a daily basis, prices will continue to close near the low. Makes logical sense, makes conceptual sense, but that's really a very foundational premise that stochastics are built on, is that assumption. So there's times when you ask yourself, hey, you know, why didn't this indicator work this time? When you understand those types of details, you understand that, hey, maybe it didn't give the right signal, because even though we are in an uptrend, you know, we closed near the low of a day and then it resumed and picked right back up the next morning. That might throw your stochastics off, but the trend may still continue to go up. As long as prices are closing near the high and you're in a strong uptrend, that's really the premise that stochastics were built on. So you're really looking to identify the range between an asset's high and low price during the given period. The current price is expressed as a percentage of the range, with 0% indicating the bottom, 100% indicating the upward bounds. So this is going to get similar to RSI. We're going to look at different values or different numbers to give you the indicator. Won't spend a lot of time on the calculation here. I did write it out for you if you're curious, but the K line is what's known as your fast stochastic. The D line is what is known as your slow stochastic. If you're curious, you can see the difference in the calculation there, the difference in the formula. But again, your charting software or trading platform should do all of the calculations for you. So trading signals can be generated when your K line crosses through your 3-period moving average, which is also known as your D line. So again, you're looking for crossovers here. You've got your 2 lines there on the bottom, your D and your K. Again, the K is the fastest, the D is the slower of the 2 lines. And what you want to watch is the D line and your price begin to change and then move into either overbought, which is typically thought of as over 80, or oversold, which is typically thought of as under 20. So again, conceptually at least, typically someone would think of at least considering potentially selling when you moved above 80, and then buying potentially, or looking at, considering buying when it moves below 20. So again, you're really looking for crossovers and then movement of your two lines. So, and then really those two boxes there at the bottom, reversals and crossovers are critical. So, and this is one thing we look at stochastics for rather often, is pivot points or reversals. So you can see there with several moves, this is back to the loonie, dollar, Canadian dollar. You can see that as you move above 80, you look there between the 14th and the 16th. On the 15th, you've moved above 80 and your K cuts below your D, right at when those candles are starting to form, right? As we talked about, it's very easy here in a static setting to say, well, of course, they're just confirming each other. But in real time, you may be on a minute or a 15-minute or an hourly chart, and as those candles start to take shape and you see a little bit of red, when you get a good signal off your stochastics to start to indicate that to you just a slice of time ahead of time as an indicator, that can be helpful to you as a trader. Again, we'll look at those live examples next time. And then again, on the upside, so you can see the reversal there, like on the 17th, we hit bottom around 10, and then the K moves up above the D, and it starts to head north to above 80. So a really good measure of not only the trend and showing the strength of the trend, but you can see the pivot point and how it acts as a pivot point when it falls below 20. Really critical to point out, 20 is not the magic level. You can see in the three instances here where we have a reversal to the upside, it really gets to 10, right? So you can't say at 20, I do X. You still need to look at other factors and just understand your own trading plan. But 20 is really the level where you want to start to look at that. Again, I may use 25, it just on an RSI, or something. So those levels depend, but in this case, you can see they dip below 20. And even the size and the shape of the dips aren't gonna, mirror each other. You can see that of the three dips, the three bottoms we have there, one is rather protracted, the first one, and the second and two are actually pretty similar. So it's a good indicator. It might confirm the bias that you already have, but certainly not going to tell you everything you need to know and work in every case. All right. Whoops. So looking for questions here. Don't see any. Again, my name's Jason from thedutchbook.com. Feel free to sign up for a free newsletter there. Thank Nadex for their time here. Sign up for a demo account if you haven't already, nadex.com/demo. And then join us for part 2. Watch the webinar schedule. Again, this was just intended to lay out some basic concepts for you, do some research and practice on your own in your demo account, and then come back next time. We'll look at some live examples and have some fun together and answer a lot more questions and take a lot more feedback. Until then, appreciate everybody joining me. Grateful for you and your attention, and good luck out there. Have a great rest of the day.